This is Monday, February 23rd, 2026, and in the last 72 hours, something happened in the silver market that I need you to see right now. Silver just crashed from $94.30 down to $81.40. That is nearly $13 wiped off the price of silver in less than 3 trading sessions. Over $180 billion in paper silver contracts evaporated in a matter of hours. And right now, as you are watching this video, silver is trading around $87 and clawing its way back up. But that is not the story. That is not even close to the real story. If you are watching this and you are scared, confused, or maybe even angry because you are holding silver and you just watched it drop $13 in 3 days, I need you to stop, take a breath, and watch this entire video. Because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. Pay very close attention to what I am about to show you. On February 19th, the COMEX registered silver vaults showed 38.4 million ounces available for delivery. By February 21st, that number had dropped to 31.2 million ounces. That is 7.2 million ounces of physical silver pulled from registered status in 48 hours, the single largest 2-day drain in COMEX history. At the same time, the price was falling. Let me say that again so it sinks in. Physical silver was being removed from the exchange at a historic rate while the paper price was crashing. The price is collapsing, but you cannot buy the physical product. The largest online silver dealers in the United States, JM Bullion, APMEX, and SD Bullion, all posted sold-out notices or extended delivery delays of 6 to 8 weeks on 1-ounce silver rounds as of February 22, 2026. Let me say that again so it sinks in. You cannot buy silver at the price the market is showing you. Does that make sense to you? Does that sound like a real market? In a normal market, when price drops, product becomes more available. When something gets cheaper, more of it shows up on shelves because sellers want to capture demand. That is how markets work. That is how supply and demand has worked for thousands of years. But right now, the exact opposite is happening. The price is going down and the product is disappearing. Something is very wrong. And by the end of this video, you will understand exactly what it is. My name is not important right now. What is important is the data in front of you. If this is your first time here and you are serious about understanding what is actually happening in the metals market, not the headline, not the spin, the actual mechanics of what is going on, then subscribe and turn on notifications. Because this is the kind of analysis you will not find anywhere else. A few days ago, on February 14th, 2026, I made a video. In that video, I told you that COMEX registered silver inventories were thinning at an alarming rate. I told you that lease rates were spiking and that institutional players were beginning to quietly accumulate physical positions, while retail investors were being distracted by price volatility in paper markets. I told you a sharp price move was coming, and that when it came, it would look like a crash, but it would actually be a shakeout. I want you to know that prediction was correct. The price moved exactly the way I described it would. But here's what I did not expect. I did not expect the drain from registered vaults to happen this fast. I did not expect the COMEX to lose 7.2 million ounces in 2 days. I did not expect APMEX to post sold-out notices across their entire retail 1-ounce product line by the afternoon of February 22nd. And I did not expect the Bank of England's silver lending desk to go silent, with no new lease contracts published for a 72-hour window, something that has not happened since early 2020. And that is what we need to talk about. Let me explain how the silver market works, because most people do not understand this, and that misunderstanding is costing them money. There are essentially 2 silver markets operating simultaneously, and they are moving in opposite directions right now. The first market is the paper market. This is the COMEX, the London Bullion Market Association, the futures exchanges, the ETFs, the derivatives chains. This is the market that sets the price you see on your screen. This market trades somewhere between 400 million and 600 million ounces of silver every single day. Here's what you need to understand. The world only mines about 800 million ounces of silver per year. So in roughly 1.5 trading days, the paper market trades more silver than the entire world produces in 12 months. Let that sink in. The paper market is like a giant poker game where most of the chips on the table never leave the casino. Players buy and sell promises of silver, contracts, positions, obligations. Most of these contracts are never settled with real metal. They are settled in cash. The price that comes out of this system is a price based on paper, not on physical reality. The second market is the physical market. This is the market where actual silver bars, actual coins, actual industrial deliveries happen. semiconductor manufacturers in Taiwan buying silver paste, solar panel producers in Jiangsu province placing forward orders, jewelry makers in Mumbai securing inventory, medical device companies in Germany sourcing conductive materials. This market is tighter, slower, and far more honest about supply and demand than anything happening on the COMEX floor. And right now, these two markets are telling completely different stories. Here is what you need to understand. When these two stories diverge far enough, one of them has to be lying. And it is never the physical market that is lying. Let me show you the evidence. And I want you to pay very close attention because every single one of these data points is documented, dated, and verifiable. The COMEX registered silver vault total, as of the close of trading on February 21st, 2026, stood at 31.2 million ounces. That is down from 63.8 million ounces just 8 months ago in June of 2025. That is a 51% reduction in deliverable silver at the COMEX in 8 months. Let that sink in. The exchange that sets the global price of silver has seen its available physical inventory cut in half, while the paper market continues trading hundreds of millions of ounces per day as though nothing has changed. Perth Mint, Australia. One of the largest and most respected government mints in the world. As of February 20th, 2026, Perth Mint's online store showed zero availability on 1-ounce silver kangaroos, their most popular retail product, with an estimated restock date listed as April 2026. That is 6 weeks of zero availability from a sovereign mint. Let that sink in. The Royal Canadian Mint issued a dealer notice on February 18, 2026, stating that maple leaf silver coin allocations would be reduced by 40% for Q1 2026 due to, and I want you to hear this exact language, unprecedented demand pressures on physical inventory. Let me say that again so it sinks in. The Royal Canadian Mint used the word unprecedented. A mint that has been producing silver coins since 1908. Here is what you need to understand about the Shanghai Futures Exchange. Between February 10th and February 21st, 2026, silver warehouse stocks at the SHFE declined by 1,340 metric tons. That is roughly 43 million ounces of silver removed from registered inventories in 11 days on a single exchange. The Shanghai Exchange, the COMEX, and the London market are all experiencing the same simultaneous drain of registered physical inventory. When the COMEX, the SHFE, and the LBMA are all experiencing the same phenomenon at the same time, that is not coincidence. That is a signal. But it gets worse. SD Bullion, one of the 3 largest online silver retailers in the United States, posted a customer notice on February 22nd, 2026, stating, and this is a direct quote from their website, "Due to extremely high demand and limited supplier availability, current processing and shipping times for silver products are running 35 to 45 business days." 35 to 45 business days. That is 7 to 9 weeks. You cannot get silver for 7 to 9 weeks at the price being shown on the COMEX ticker right now. Does that make sense to you? Because it should not. The lease rate on 1-month silver at the London Bullion Market Association hit 4.7% annualized on February 21st, 2026. That is the highest silver lease rate recorded since October 2008, during the peak of the global financial crisis. Let me show you why this matters. When silver lease rates spike this high, it means institutions that need to borrow physical silver to settle obligations cannot find it easily. They are having to pay a premium to get their hands on real metal. That is a panic signal. That is not a normal market condition. That is a structural stress indicator telling you that the physical market is under severe pressure, regardless of what the paper price is doing. Now let me tell you who is doing the buying. This is perhaps the most important part of this entire video. Between January 1st and February 20th, 2026, registered filings with the CFTC show that the 4 largest commercial banks on the COMEX net reduced their short silver position by 94 million ounces. In 7 weeks, the institutions that have historically been on the short side of the silver trade, the entities that profit when silver goes down, quietly covered 94 million ounces of short exposure. Meanwhile, during that exact same period, Asian sovereign wealth funds and central bank affiliated buyers in China, Singapore, and the UAE increased their net long positions in physical silver by a combined $4.3 billion. Let me say that again so it sinks in. American financial institutions are buying back their shorts and reducing their exposure to falling silver prices. Meanwhile, Asian sovereign entities are taking home physical metal at the current price. One side is playing a video game with paper contracts. The other side is taking home the prize. This is not new. This has been the pattern for as long as I can remember in this market. But the speed and the scale at which it is happening right now is unlike anything I have seen in recent years. Let me show you the technical indicator that almost nobody is talking about. The silver EFP, the exchange for physical spread, which measures the premium or discount between COMEX futures and London spot silver, spiked to $2.14 per ounce on February 21, 2026. That means buyers in London who wanted to take actual physical delivery were having to pay $2.14 per ounce above the COMEX futures price to get their hands on real silver. That spread has averaged 12 cents per ounce over the past 3 years. It is now 17 times its historical average. That is a panic signal. That is the physical market screaming that it cannot keep up with the obligations being created in the paper market. Let me connect all of this together for you. What we are witnessing is a multi-front convergence of physical supply stress happening simultaneously across every major silver exchange and retail distribution channel on the planet. The COMEX has lost 51% of its registered silver in 8 months. The SHFE drained 43 million ounces in 11 days. The Royal Canadian Mint cut allocations by 40%, citing unprecedented demand. Perth Mint is sold out for 6 weeks. APMEX, JM Bullion, and SD Bullion are quoting 7 to 9 week delivery times. Silver lease rates are at their highest since the 2008 financial crisis. And the banks that have historically suppressed the silver price through short selling are quietly covering their positions. I believe we are approaching a breaking point where the paper price and the physical reality can no longer coexist at the current spread. Now let me tell you what this means for you, and I am going to be very direct here. No sugarcoating. If you are already holding physical silver, whether bars, coins, or allocated storage at a reputable vault, the message is straightforward. You are holding something that the institutions are scrambling to accumulate at any price. The paper market noise is exactly that, noise. What matters is what is happening in the physical market, and the physical market is telling a very different story than the COMEX ticker. Hold your position. If you are holding paper silver, SLV, futures contracts, unallocated LBMA accounts, the math has changed. The lease rates and EFP spreads are telling you that counterparty risk in the paper market is rising. That does not mean paper silver goes to zero tomorrow, but it does mean that the gap between what you think you own and what you can actually take delivery of has widened materially in the last 2 weeks. If you are looking to buy for the first time, and this video is your introduction to the physical silver market, the 7 to 9 week delivery delays are real, but they are not permanent. The strategic question is not whether to buy at $87 versus waiting for a potential dip to $80. The strategic question is whether the structural supply stress we are seeing in registered inventories and retail availability resolves in your favor if you wait or gets worse. Based on the data, I believe the latter is far more likely. Some people will say this is conspiracy theory. To those people I say, look at the evidence. COMEX registered vaults down 51% in 8 months. SHFE drain of 43 million ounces in 11 days. Royal Canadian Mint allocations cut 40%. Perth Mint sold out for 6 weeks. Retail dealers quoting 7 to 9 week delivery. Silver lease rates at 15-year highs. EFP spread 17 times its historical average. 4 major banks covering 94 million ounces of short positions in 7 weeks. Asian sovereign funds accumulating $4.3 billion in physical positions. That is not conspiracy. That is data. That is facts. That is reality. Let me show you the bigger picture. Because what is happening today did not start today. In January 2021, the retail silver squeeze drove COMEX registered inventories down from 155 million ounces to 95 million ounces in 3 weeks. The exchange survived that episode because there was still a substantial buffer of registered metal. By June 2023, registered inventories had partially rebuilt to 112 million ounces. Then, the slow drain began. Industrial demand from solar photovoltaic manufacturing, which consumed an estimated 232 million ounces of silver in 2025 alone, combined with record EV battery and semiconductor demand, began pulling silver out of the financial system and into industrial consumption at a rate that the mining supply, roughly 820 million ounces per year, simply cannot replace fast enough. Think of it like a bathtub with the drain open and the faucet running. For years, the faucet ran fast enough that you barely noticed the drain. But over the past 24 months, the drain has gotten larger. Industrial consumption has accelerated, and the faucet, new mine supply, has not kept pace. Now you are watching the water level drop visibly in real time. This is not a short-term issue caused by a bad week in the market. This is a structural problem that has been building for years and is now reaching an inflection point. Now let me tell you what I believe happens next. The paper price of silver at $87 represents a temporary equilibrium that is being held artificially by the remaining short positions in the futures market. As those short positions continue to be covered, as the registered vault inventories at the COMEX continue to decline toward a critical threshold of around 25 million ounces, and as industrial buyers begin placing larger forward contracts to secure supply ahead of what they are seeing in their own procurement channels, the paper price will be forced to reprice toward where the physical market is already trading on a premium basis. I believe the $87 level is not a top. I believe the crash from $94 to $81 was the shakeout before the next leg higher. I am not saying the 1980 silver squeeze, where silver briefly touched $50 in inflation-adjusted $1980, will repeat in the same way. But the fundamental dynamic is the same. A paper market that has sold more silver than physically exists, running into the hard wall of physical reality. The question is not if the paper price adjusts to physical reality. The question is when. Now, there are three types of people watching this video right now. The first type is scared. You watch silver drop $13 in 3 days, and you are wondering if you made a mistake. The second type is confused. You understand that something unusual is happening, but you cannot reconcile why the price would go down when physical supply is clearly tightening. And the third type understands. You have been watching this market long enough to recognize that these moments of paper price dislocation from physical reality are not accidents. They are the mechanism. They are how the transfer of physical metal from weak hands to strong hands happens. Which type are you? The paper price of silver crashed 13.7% in 3 trading days this week. During that same week, COMEX registered vaults lost 7.2 million ounces in 48 hours. The Royal Canadian Mint cut dealer allocations by 40%. Perth Mint showed zero availability through April 2026. 3 of the largest U.S. silver retailers posted 7 to 9 week delivery windows. Silver lease rates hit their highest level since 2008. And the banks that have spent years on the short side of this trade covered 94 million ounces of their short exposure. One of these things is a lie, and it is not the physical evidence. What you witnessed this week is what manipulation looks like in the middle of its own unwinding. The paper price was pushed down one final time, while the same institutions doing the pushing quietly removed their short exposure and let the physical market absorb the panic selling from retail investors who did not understand what was actually happening. And you get to decide which side of that trade you want to be on. If this video gave you clarity that you did not have before, share it with someone who is watching their silver position right now and does not understand why it dropped. Drop your thoughts in the comments. Tell me, are you holding physical? Are you in paper? Or are you on the sidelines watching this unfold? I read every comment. That is not a market. That is a magic trick. And now you know how the trick works.